When you hand over the reins of a $4 trillion company, you are not just passing a baton, you are transferring control of an entity that basically holds the GDP of a mid-sized nation in its cash reserves.
Right. I mean, the global economy treats Apple as a sovereign state. Any shift at the top rewires how capital flows across the entire tech sector.
Exactly. Welcome to the Deep Dive. Our mission today is to tear down the mechanics of a shock transition. Tim Cook is stepping down as CEO of Apple.
Yeah, which no one saw coming this early.
No one. We are pulling from recent reporting, Trading Key, Macworld, Mech Rumors, 9to5Mac, and supply chain data from Manufacturing Transformation Group. We're going to analyze the strategy of this timing, the reality of Apple's upcoming Q2 2026 earnings, and how they plan to survive a highly competitive future in AI and global supply chains.
Because the stakes here are, well, they're existential. When Tim Cook took over in 2011, Apple's market cap was what, roughly $350 billion?
Yeah, something like that.
Right. He grew it by more than 1,900%. The market priced in absolute perfection under his operational control.
So we have to look under the hood. Is the new CEO inheriting a well-oiled machine or a $4 trillion company facing an identity crisis? Let's get right into the mechanics.
Yeah.
The memo drops on April 20. Cook steps down September 1st, moving to executive chairman. John Ternus, who is currently the senior VP of hardware engineering, takes the CEO spot. And Johnny Sfroogi steps up as chief hardware officer.
Look, Wall Street was caught completely flat-footed by that September 1st date.
Right, because the consensus was 2027 at the earliest. I mean, we are standing on the edge of a massive product supercycle. Apple is rolling out that foundational overhaul of Siri this spring, a flood of smart home hardware, and the supply chain leaks point to touchscreen MacBooks.
It's a huge pipeline.
It is. I look at this and see a legendary head coach retiring right before the Super Bowl kickoff. Why walk away right before the massive 26-27 product wave hits the market? Why not retire on that high note?
It looks counterintuitive, I know, but you have to analyze it through the lens of corporate valuation. Staying for the climax is actually, it's the most dangerous thing a CEO can do for their successor's stock price.
Wait, let me push back on that. If Cook oversees a flawless launch of these categories, he hands over a company at peak value.
Yeah.
How is that dangerous?
Because markets are forward-looking mechanisms.
Right.
If Cook stays through 2027, launches the new Siri, drops the hardware, and then hands over the reins, Ternus inherits a post-climax lull.
Oh, I see.
Yeah. He steps into the CEO role right when the hype cycle is cooling down. Capital expenditures have peaked. Wall Street looks at the pipeline and says, well, what's the next catalyst?
And the pipeline's empty.
Exactly. The stock would almost certainly correct. By exiting on September 1st, Cook essentially gifts Ternus the honeymoon period of a lifetime.
So Ternus gets to be the face of the new wave.
Right. He builds immediate momentum. He drives revenue beats in his first 3 quarters. The market associates his early tenure with aggressive growth. Plus, Cook isn't disappearing. As executive chairman, he'll be mitigating transition risk without casting a shadow over daily operations.
That brings us to John Ternus himself. He joined Apple in 2001, viewed as a continuity candidate. But I have to look at the macroeconomic landscape and ask, is this the wrong guy for the era?
It's the multi-trillion-dollar question.
Right, because we are in the middle of an AI revolution. Putting a hardware engineer in charge right now, I mean, it feels like putting a battleship commander in charge of a cyber warfare unit.
Wall Street is deeply divided on this exact paradox. Ternus deeply understands Apple's design language and their supply chain rhythm, but you're highlighting the existential vulnerability here. Apple is an AI laggard.
Yeah, their former AI chief, John Giannandrea, quietly retired late last year in 2025.
And Siri was moved under Mike Rockwell, the Vision Pro lead.
And their fundamental AI strategy feels completely disconnected from the industry. You look at Meta, Alphabet, Microsoft. They are incinerating hundreds of billions of dollars on custom silicon and proprietary large language models. Apple is refusing to play that game.
They're sitting out the infrastructure arms race entirely.
Exactly. They are hoarding over $130 billion in cash. Instead of building their own massive brain, they partner with Google Gemini to power the upcoming Siri overhaul.
Though they did quietly spend $2 billion acquiring that Israeli AI startup, Q.AI.
Right. So help me understand this. Let's use an analogy. Is Apple basically letting competitors spend billions to build the roads, while Apple just sits back and collects the tolls from the iPhones driving on them?
That toll road strategy is incredibly potent. It's the absolute core of their margin defense.
Really? Explain that.
Look at Q.AI to understand the mechanics. They specialize in model quantization. That's the process of compressing massive AI models so they can run locally on an iPhone's neural engine instead of relying on a massive cloud server. So the data never leaves the phone.
It never leaves the phone. And more importantly, for Apple's bottom line, Apple doesn't have to pay for the server compute power to answer every single prompt.
That's massive.
Right. By partnering with Google Gemini for complex world knowledge queries and using tech like Q.AI to handle the local personal queries on device, Apple avoids building a $100 billion server farm.
So if AI models just become commoditized, Apple didn't waste a decade of profits. They just plugged the winning model into the phone.
Exactly. It is financial genius on paper.
But there has to be a structural risk there.
Oh, massive structural risk. Total disintermediation. The sector is shifting toward an agent-based ecosystem. Soon, you won't open individual apps. You'll just speak to an overarching AI agent that executes tasks in the background.
Right. Booking flights, managing your calendar.
Yeah. And if the agent answering your questions is Google Gemini, Apple loses its moat. Apple's valuation is predicated on owning the sticky relationship with the user. Right. If Google owns the relationship, Google commands the premium. The iPhone just becomes a beautifully machined piece of aluminum.
A completely commoditized hardware shell.
Wow. And even with this restrained capital strategy, the AI boom is still hitting Apple right in the wallet. Which brings us to the Q2 2026 earnings crucible.
Margin squeeze.
Yeah. Ternus is taking over a company with a stock price that's largely flat, up only 0.5% year-to-date by late April. But the Q2 earnings guidance for April 30th looks aggressive.
Very. They're projecting between $107.8 billion to $110.7 billion in revenue.
And the sources show some contrarian bright spots. iPhone sales in Greater China are surprisingly robust, up 23% in the first 2 months of the year.
Which is shocking.
It really is, especially since the broader Chinese smartphone market actually declined by 7.7% in that same period. How is Apple capturing that delta?
Channel financing and semiconductor yields. Apple initiated highly targeted pricing discounts in Tier 1 Chinese cities right as domestic competitors, like Huawei, hit production bottlenecks on their next-gen chips. Yeah, Apple essentially absorbed a premium upgrade cycle by being the only company that could deliver devices at volume.
That perfectly proves the value of having a supply chain operator like Ternus at the helm. But there's another bizarre revenue driver in the sources, the Mac Mini.
The OpenClaw surge.
Yeah, exactly. Mac Mini sales have surged recently due to OpenClaw projects. What is OpenClaw, and why does a desktop computer move the needle for a $4 trillion company?
It's a fascinating disruption. OpenClaw is an open-source framework that lets engineers string together multiple Mac Minis to run massive local large language models.
Why use a Mac Mini instead of a dedicated server?
Apple Silicon's unified memory architecture. To run massive AI models, you need vast amounts of highly efficient memory. Dedicated AI GPUs from NVIDIA cost, $40,000 each.
And they're impossible to get.
Right. Developers realized clustering high-end Mac Minis gives them enough unified memory to run these models locally at a fraction of the cost. Apple accidentally built a budget AI server farm, and developers are buying them in bulk.
So they capture AI revenue without building AI data centers. That's the bull thesis. But there is a glaring bear case hiding here. Morgan Stanley issued a major warning on gross margins.
Yeah, this is where the macroeconomic shockwaves hit. The global appetite for AI servers has completely broken the memory chip supply chain.
Because everyone is buying them for AI clusters.
Exactly. Morgan Stanley notes that memory chip prices spiked 40 to 50% in Q1, and they expect another 20% jump in Q2.
This is the ultimate irony. Apple intentionally avoided spending billions on AI servers to protect its bottom line. But the global AI craze is basically taxing Apple by driving up the cost of the basic memory chips they need for every single iPhone and Mac.
The AI tax is unavoidable, and here's why Wall Street panics over this. Even if revenue's up, squeezed margins terrify investors.
Because Apple trades at a premium multiple based on its margins.
Exactly. They enforce a 45% or higher gross margin. If the internal cost to manufacture an iPhone spikes by $20 per unit, Apple can't just raise the retail price in a stagnant consumer market without destroying demand.
So they eat the cost.
They eat the cost. The margin compresses, profit shrinks, and Wall Street recalculates the multiple, which shaves hundreds of billions off the market cap.
Which puts Ternus in a brutally tight corner. He has to find extreme operational efficiencies elsewhere. He has to completely rewire how Apple builds its physical products.
Right, which shifts the narrative from product design to pure logistical survival.
And he's stepping into some difficult hardware realities. The Vision Pro launched in February 2024. Sources say it has sold fewer than 1 million units. The $3,000 price tag signals large-scale adoption just isn't happening.
Look, the Vision Pro is a distraction right now. The actual threat is the geographical concentration of their supply chain.
The great supply chain migration. Apple is planning to move 25 to 30% of U.S. iPhone production completely out of China over the next 3 to 5 years.
Shifting to India, Vietnam, and moving MacBooks to Thailand?
Plus, committing over $500 billion to U.S. investments over 4 years? I mean, trying to navigate this untangling, it's a logistical nightmare. It's like trying to rebuild a car's engine while driving 80 miles an hour down the highway.
It really is.
Is this supply chain migration actually Ternus's most important job? Even more than designing the next cool gadget.
Absolutely. Tim Cook has a famous operational mantra: nobody wants to buy sour milk.
Meaning inventory depreciation.
Exactly.
Yes.
The most brilliant AI software and hardware designs are entirely useless if Apple can't physically manufacture and ship the devices smoothly.
Right.
Diversifying out of China is essential for long-term survival, but it is incredibly delicate. You aren't just moving a factory. You are trying to recreate decades of specialized labor and logistics networks in countries that have never manufactured consumer electronics at this density.
And if a single Tier 3 supplier in Vietnam fails to deliver the right screw, the entire global delivery mechanism paralyzes.
Right. It's expensive in the short term and highly prone to defect rates.
Then why take on the margin hit?
Because the alternative is corporate suicide. Remember the Zhengzhou COVID lockdown?
Yeah.
That single Chinese mega factory going offline cost Apple an estimated $1 billion a week in lost revenue. You cannot run a $4 trillion company with a single point of catastrophic failure. Factor in geopolitical posturing, and de-risking from China is a mandatory survival play.
Which brings us full circle. This perfectly crystallizes why the board chose a hardware supply chain expert over a software visionary. Ternus knows how to keep the physical machine running.
Yeah, which is the prerequisite for everything else.
So distilling this deep dive down, Tim Cook leaves behind a $4 trillion legacy. But John Ternus inherits a complex web of challenges. He must flawlessly execute a massive supply chain migration. He has to navigate tightening profit margins caused by global memory chip costs.
And he has to prove that Apple's outsourced, pragmatic AI strategy can actually compete.
Exactly. And for anyone listening, whether you hold Apple stock or just use their devices daily, the success or failure of this transition dictates the consumer tech landscape for the next decade.
It absolutely does.
If you remember one thing, it's this. The famous Apple ecosystem walled garden was built on owning the whole experience. But if Apple's hardware increasingly becomes just a beautifully designed vessel for third-party AI like Google Gemini, does that walled garden lose its magic? If Siri is just Google in disguise, what exactly are you paying a premium for? Think about that before your next upgrade. We'll see you on the next deep dive.